This podcast is for general information only. If you're after advice for your own situation, it's best you chat with a licensed financial advisor.
Welcome to O'Rellan's Intergenerational Thinking podcast. My name's Rachel Weld, and today in the studio I'm joined by Colleen Raab, who is Portfolio Manager and Lead Strategist for Sustainable Solutions at Los Angeles Capital. LA Capital are a global quantitative investment manager with over $31 billion of funds under management and are one of the three underlying managers of the O'Rellan Global Shares Fund. Welcome, Colleen, to the podcast and to New Zealand.
Thank you, Rachel. It's great to be here.
Firstly, can we start by understanding a bit about LA Capital?
Los Angeles Capital is a global quantitative equity manager. We were founded in 2002 and we're headquartered in Los Angeles. We manage equity portfolios across a range of strategies. We cover about 20 plus different equity strategies covering global and emerging markets. And we manage assets for institutional investors across North America, Europe, Asia Pacific, and specifically within Australia and New Zealand. We've been managing institutional assets since 2020. The firm really was founded to address the need for a forward-looking, systematic approach. And so we developed our process to bridge the gap between traditional backward-looking quantitative methods and forward-looking fundamental managers. And it's really been our philosophy has been consistent since our founding in 2002. We're also 100% employee-owned, which I think really matters in terms of we are aligning our own interests with our clients' interests. So our success is very much aligned with the success of our clients. And that's been something that's been very important to us over the last 2 decades and has been able to bring continuity across our investment process.
So what drew you to quantitative investing?
Sure. So I studied economics in college, and I've always had a bit of a right brain math background. And I think what really drew me towards quantitative investing was the ability to systematically understand how markets are being priced and how they're acting in any given period. And it was sort of markets were always a very interesting subject to me. I very much liked the macro component of economics and toying that with the quantitative techniques, being able to understand why investors are pricing certain assets, how markets are relating to each other was always something that I found to be very interesting to me. And so, I spent a couple years right outside of college in boutique M&A work for a private equity firm, and that really helped me understand the underlying fundamentals of valuing a company. But then from there, really taking it back towards the quantitative, systematic side is how I found myself into LA Capital. And I really believed in this forward-looking approach and being able to tie the systematic sort of math side of it to real world outcomes and real world applications was really what drew me into this area.
Mm. Oh, that leads me to my next question, is that many people think of quant investing as a bit of a black box and it literally spits out a list of investment recommendations. What is it that you actually do? What is the investment process of LA Capital?
I may first start talking a little bit about our investment philosophy, which is what we call investor preference theory. And it's this idea that investors have certain preferences in the way that they're investing, and those preferences are continually evolving. And so this is really the DNA, the core component of our investment process, that markets are dynamic and they're continually adapting and changing as investors are pricing and valuing their investments. And so this is really what drives our investment process. We are very transparent with the way that we're building our model and the way that gets applied and implemented within our portfolios. And it's this core idea that the model is updating as markets are changing and adapting. And so our dynamic alpha stock selection model is built to price 30 different fundamental factors across 9,000 stocks globally. And as we're updating our models, we're being able to understand how investors are changing their views at any given time. And so to really make this more concrete, there's 5 steps within our process. It first starts with factor research. So we are identifying the factors that market participants are paying attention today. This can be anything from the earnings quality of a company, valuation characteristics, management effectiveness, sustainability criteria. So across a range of different themes that all investors care about. The second step in our process is then deriving the model views of each of those factors and teasing out that risk premium component, the portion of the factor return that is going to be repeatable moving forward. From there, in this third step, we're combining those first 2 portions. We're creating the underlying stock level alpha forecast for all 9,000 stocks within our global universe. And then those stock level alphas go into our 4th step, our portfolio construction, where we're utilizing a robust optimization process to maximize alpha and minimize investment risk, transaction costs, and model uncertainty. And then the 5th step of our process is then taking that and implementing it through our trading team and executing those trades to develop the ultimate optimal portfolio. And so that 5-step process is the core of our investment process, and it has remained consistent since our founding in 2002. Yeah. And I think we have a very strong focus of we are very transparent with our clients in terms of what goes into the model, and then also how each of those model factors result in the portfolio performance. So when you sort of think about black box traditional black box type of quantitative firms, we're really trying to be very open and transparent so that our clients understand what's in their portfolios.
So where does human judgment play a role in your portfolio?
I think it's, important to consider where in the process human judgment comes into play. And so first and foremost, it's in the beginning of the process in terms of identifying the different factors that we're using within the model, as well as identifying the portfolio parameters for when we go to implement the model. Our process is quantitative and systematic. I would say it's 99% systematic, though there are certain components of human judgment that need to come into play. So if there's, let's say, a stock that runs away in price, maybe we need to take a look at that. Or if there's something that is outside of the model, something going on in the markets that maybe we feel the model hasn't been able to fully digest and put in price at that time, there will be human judgment and human oversight in terms of that. And anything that is sort of outside of the investment process does require approval or oversight from our investment committee. And so it's important to recognize that while we have this systematic process, there is a level of oversight by our investment committee to ensure that we're paying attention to what could potentially be not priced by our model today.
So what is your model seeing in the markets today?
I think that's a really great question. I think this year has been really a story of 2 distinct environments. Earlier in this year, we came into 2026 really carrying a lot of the themes that we saw driving market returns in 2025. But then in March, with the disruption in the Middle East and disruption to oil, we saw a rotation and a pretty significant sharp repricing of returns towards energy and towards more value-oriented companies. In April, that actually reversed pretty significantly back towards more growth-oriented, more AI enthusiasm, back towards the Mag 7. And these types of markets are, I think, what's really why a adaptive and dynamic process is really important for us. The model was able to translate some of the behavior that we saw over the course of those couple of month periods and adapt to those changing preferences. So as we sort of enter the middle of the second quarter, our model is really focused on, I would say, a increase in risk appetite, but importantly in a very quality-oriented framework. So we're taking a very disciplined approach to some of the risk-on appetite that we're currently seeing. And while the valuation preference that we had seen within our model back in March, that has been pared back, and we're seeing more preference for those growth-oriented names, more secular and cyclical growth, more higher volatility names, but again, very importantly, in a higher quality framework where we're focused on companies with strong management success and effectiveness, stronger balance sheets. We have a refocus on larger cap companies, those with positive analyst revisions. When we think about our model, and I think it's important also to note that there can be a confluence of characteristics that we like in any given environment. It's not always black and white. We like value today or growth today. Today, actually, we see a picture that's more of growth at a reasonable price. So with the 30-odd factors within our model, we're able to develop very interesting and concrete views of how investors are pricing assets today.
So when does your model typically outperform? And when you do go through periods of poor performance, how do you get confidence that it's not a broken model, it's just a period of, difficult performance?
I think this is a really great question, and I think it's really important as investors for us to understand when our model works and when our model doesn't work. Our model, given the fact that we're ingesting new information on a daily basis and we're adapting that into the portfolios, the market environments where we typically tend to outperform are periods where we do see more stability in investors' preferences. And so environments where there's a consistent and stable view over certain periods, that will be an easier market for us to outperform because we don't have to turn over the portfolio as much to get new views into the portfolio. The periods where our strategy struggles a little bit more is when we begin to see more rapid repricing of risks on shorter periods. And that is just because in order for the portfolios to catch up, we have to see the new views reflect in the model. That then has to carry into the portfolios. And so when you see a lot of volatility in factor behavior on a shorter period, it could be a little bit more of a headwind for us. I think, though, that part of our process, the dynamic nature of our process, helps us withstand from those periods where it, helps us give us confidence in our model, because if something's not working for a period of time, the model will adapt and adjust to that in itself. We also do attribution analysis on our model, so we're able to understand when our factors are outperforming or underperforming, and that'll give us confidence as well in our model to understand and ensure that the way the model's performing is reflecting how the market is actually behaving, and being able to analyze those two things together is how we really pay attention to, is the model working or is the model not working?
And I guess the last couple of months is a great example of how the portfolio's changed with the changing environment.
Yes, exactly, yeah.
How is ESG handled in the portfolio?
So, and this is, a very important part of my job as the lead strategist for sustainable solutions at LA Capital. We have been on this journey in responsible investing since 2015, and it's really been an evolution for how we've been integrating ESG into our investment process. The research that we do on the ESG side is is in the same lens of all of our other traditional factors as well. So it's not a siloed process. And I think that's really important for us in that we're not just doing exclusionary screens, or ESG isn't just an overlay on top of the portfolio. We have factors that our research team has analyzed and developed over the course of, the last 10 years or so to understand how investors are pricing ESG characteristics today. And so we have an array of ESG factors that are in our stock selection model. And that is because we believe that investors are paying attention to these factors today. We believe that there's a risk and return component to ESG signals. And so we've done a lot of work in terms of creating signals that are capturing a lot of these sustainability themes. And just to give a few examples of what we're currently incorporating in our investment model, we analyze the sustainability of a company. And so we incorporate the SASB materiality framework in order to identify the sustainable components of a company's business that is actually financially material on their business operations. We also take into consideration carbon and climate analysis so that we can understand a company's projection for, are they going to outperform in a transition to a lower carbon economy, or what are the physical risks that are associated with their business operations? And then we also create peer group networks just based off of ESG considerations. So understanding co-movement between companies that have similar business operations, or understanding being able to create groups and assess groups of companies based off of their ESG characteristics. So there's a lot of different techniques that we use in the modeling process on ESG. There's also for investors who want to take a additional sort of step in responsible investing and want a more targeted approach, we can then take those unique insights that we've developed at the model level into portfolio construction and elevate those if an investor is interested in a sustainable oriented objective, if they want to integrate carbon budgets and limit the amount of emissions in their portfolio, or screening on certain industries or responsible investing themes. So there's a lot of different ways we can take the research that we've done at the model level to integrate that at the portfolio construction approach.
Yep. And how much of an impact has AI had on the investment process?
Yeah, this is a really hot topic today. And so we have been using machine learning techniques within our process for quite some time. So just to give a couple examples of what we're doing there, this has been an evolution in itself as well. And we first began with natural language processing on unstructured data to really analyze the text associated with earnings call transcripts or news events. So we really started there, and then from there began to take into account more machine learning clustering techniques to identify groups of companies, how companies are moving together and the co-linkages across that. And I think what's been really interesting in how this has developed over the last couple of years is those techniques really used to sit primarily with the researcher who understood how to develop those models. Where we're going today is now being able to integrate AI in other parts of the investment process. And so giving those tools to other people on the investment team to be able to play with and analyze and come up with their own views. That's sort of where we're seeing sort of a lot of growth within the last couple of years. I think what's also very important when you consider integrating AI in your investment process is understanding the biases and the risks associated with that. So we do still take a very a close look, and there's a lot of oversight and governance in using AI in the investment process. So while we have the ability for others on the investment team to use those tools, when it comes down to actually incorporating it in the investment model, that still goes through the rigor and the testing of our investment committee to ensure that the techniques being used in those factor constructions are appropriate and rigorously tested.
So how often would human intuition override the model?
So this is... it's pretty few and far in between, I would say. I mean, again, we're 99% systematic. There are environments where we do have to pay attention to, do we believe the model is understanding what's going on in the markets today? If there's some shock, say COVID, for example, was an area where we had never seen a global pandemic like that before. So the model had to understand what was going on in the markets. I think what's actually an interesting example, last year in 2025, we saw a surge in gold prices. And with that, gold miners saw strong returns due to a confluence of factors, both having the exposure to gold, but also strong momentum, also positive analyst earnings revisions. So there was a variety of fundamental reasons why gold miners were doing quite well last year. Our model really picked up on that and was pushing us into those gold miners. I think what was important for us to think about was, is our model or is our risk model actually understanding what is going on with these gold miners and their outperformance from last year? And unless you had a specific gold factor in your risk model, you weren't going to be able to identify that as a risk based off of this materials. Instead, it was picking up on momentum risk, volatility risk, and we understood that our risk model wasn't looking at our positions in gold. It was looking at it as if it was just one bet. And so with that, it was important for us to integrate our risk management process. And those are some of the types of environments where the model may be pushing us in one direction, but intuition's really telling us maybe we should be thinking about this in terms of a more risk-controlled manner, and our risk management process really kicks into gear in those environments. So it really does show you how, while it is truly systematic, the portfolio management team, part of their responsibility is ensuring and understanding that where the portfolio is today is that where we're seeing the markets actually unfolding.
So how do you ensure that the portfolio is diversified and not sort of all in one factor that the model really loves?
Yes. This is built within our optimization process. So we build our portfolios through a robust mean variance optimization, and that robust component is where this diversification really comes through. And with our portfolio construction, we are maximizing alpha, maximizing expected return, while minimizing investment risk, transaction costs, and model uncertainty. And that's that component that really helps us build diversified portfolios. And what it does is it is trying to find stocks that have multiple alpha drivers behind it, as opposed to any one concentrated factor or idea. Mm-hmm. And the result of that is building a portfolio with diversified stocks, with diversified drivers of return. And it is part of our risk management process that we feel is very proprietary to us, and also is very important in how we can build diversified portfolios. What we'll find is, while there may be a certain factor or theme that's in vogue today, by building portfolios with many factors within our model that are currently favored, it really helps withstand a reversal or a drawdown to any one factor.
Mm. So given these a couple of quite significant IPOs in the future, can LA Capital participate in those, and how does the model incorporate those when it doesn't actually have the history to feed off?
This is, a question that we've actually been getting a lot more recently, just given some of the larger IPOs coming to play this year. First and foremost, we do not, as a firm, invest or allocate to IPOs. And part of that is a compliance reasonings as well, but also our model, as you said, needs some level of history and some data to be able to actually assess the company. So the way that we approach significant IPOs is once it hits the secondary market, we'll begin to be able to ingest that data, and the model will be able to begin to price and come up with a view on that stock. And so with certain big IPOs coming to play, the most important component of that is what is the weight going to be in the benchmark. And so depending on client guidelines, if there is a big name coming to play, will allow the model to ingest that data, come into a view, and then we may invest or allow investment in that name prior to it actually being added to the benchmark so that we can get early exposure to it. But again, it's very much driven by how the model is going to view that stock. So we won't just assume that we'll allocate to this name. We'll likely want to allocate to maybe a benchmark level at the minimum, but we'll really allow the model to decide whether or not what level of allocation it wants and at what point as well.
Right. Oh, that's fascinating. Now we come to the part of the podcast where we learn a little bit more about you. What's your favourite holiday destination?
Well, as being born and raised in Southern California, I tend to really love a winter vacation. I'm a big skier, so I go up to Lake Tahoe a lot and go skiing. I probably go up a couple times a year, and then I typically will love to do a winter vacation just so I can get some snow or some colder weather. I love a beach vacation, but I'm very grateful and thankful that I can get that almost year-round in Los Angeles. So I typically will tend to go to a mountain or a ski destination just so I can get, a little bit of snow and fun.
Oh, lovely. There's some pretty good ski fields down in the South Island. You might have to
I just
put those on your
learned
bucket
about
list.
this. So.
Yeah. And is there a book or a podcast that you'd recommend?
Sure. I think I'm gonna stick with the podcast ones. I do listen to a lot of podcasts. I think one that I would recommend just for people in our industry who are paying attention to the markets. I listen to the Wall Street Journal's What's News podcast. It comes out twice a day. It's very quick. It's about 7 to 10 minutes each, and so it's a very quick way to just see what's going on in the markets on a daily basis. Another podcast that I would recommend for sustainable investors is PRI's Responsible Investing podcast, and it gives a great rundown of all things in responsible investing and how investors should be paying attention to what is going on today and how we as responsible investors can really help drive more of those outcomes.
Oh, fabulous. Tea, coffee, or something stronger?
I'm going to have to go with coffee here. I'm an avid coffee drinker, and I can say I love being down in this area because I know coffee is really important down here. I know a flat white is the big one to drink here. I do love a flat white, and I actually just got my own espresso machine, so I've been trying to curate and craft my own ability to create my own coffee.
Oh, lovely. Good luck with that American milk, though. What's a service or something that you've purchased recently that you're really enjoying?
I think a lot of people will say the same answer, but I, have just started using Claude both for my personal life and also within my job. And it's just pretty amazing, the technology and what you can do with it. I have played around with ChatGPT. I've done Google Gemini, and Claude is just, as everyone will say, is above and beyond. It's really fun to be able to play around with these AI tools. help myself personally, but then also really think about how we can be leveraging AI in our own day-to-day responsibilities at work.
Well, thank you so much for your time today, Colleen. And we very much appreciate you travelling all the way to Wellington to join us in studio. It's been very, very insightful and great to understand more about LA Capital's process.
Great. Thank you so much, Rachel. It's been a pleasure being here.
Great. I hope you enjoyed today's podcast. If you would like to learn more information about O'Rellan, follow us on LinkedIn or visit our website, orellan.com.
Thanks for listening to the O'Rellan podcast. Everything we've shared is general information only, not financial advice. If you'd like guidance in your own situation, please talk to a licensed financial advisor.